Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Anthony Crowdell, Managing Director at Mizuho Americas, to discuss why earnings resiliency is the key theme for utilities sector in 2023. Anthony, it's great to have you with us. Welcome to Trade Talks.
Hey, good afternoon, Jill.
All right, and let's start with the sector more holistically and why regulatory pushback is on the rise. Why is that?
Sure. If you think of this sector, we're spending large amounts of capital growing what we call rate base, and that's actually the biggest earnings driver. But as utilities grow rate base, it also impacts customer bills. And, over the last 10, 15 years, regulators have been very, very supportive of these capital plans and the impact to customer bills. But you now tie together, the inflationary environment we're having, higher interest rates, which is also impacting the company's financing plans, raising their borrowing costs, which that raises it past the consumers. Now we have a lot of what we're going to call headwinds. And one of them is affordability. Customer bills are going up a lot more than just 1 or 2%, which is what they've done historically over the last 10, 15 years. And regulators are getting concerned that maybe these robust capital plans are really hitting consumers who are on the margin, and they may start pushing back and saying maybe soften the plans or let's push off some renewable spending or, big CapEx plans. And that's our concern. Regulatory pushback, we think, could really dent in that earnings resiliency that we've seen over the last 10, 15 years.
Right. So let's talk about that. How will earnings resiliency be the key theme for 2023?
Well, some of the utilities in this space, if we just take a couple like CMS, CenterPoint, or DTE, or Excel, they have a great track record of delivering on their earnings guidance, regardless of what the macro headwinds are. If we just think of DTE, it's based in Detroit Edison, that's the electric and gas utility there. Regardless of whether it's been recession, pandemic, the company's been able to deliver on their roughly 6 to 8% earnings guidance. CMS, I think, has like 17-year history of delivering 7% earnings guidance. And so that, though, we could really dig deeper and look at it and say, well, that also happened if you think of the last 15 or 17 years. We've had declining commodity prices. We've had declining financing costs. We've even had declining taxes if you think of the 2018 Trump tax cut tax plan. So those are great tailwinds that enable a company to deliver on their earnings growth. But now two of those three, and potentially the higher taxes could be coming, they all reverse themselves out in the last 6 to 8 months. And now as companies give us their 2023 plans, the concerns are that the headwinds are too great and maybe they will stumble delivering on their earnings growth rate. Right now, the earnings growth rate average for the sector is somewhere between 5 and 6%. And as we saw on the third quarter earnings calls in late October, early November, you saw some companies like some of the smaller cap names already, Avista, Black Hills, BKH, they've already gone out there and started maybe warning the market that it's going to be hard as interest rates and inflation have ramped up. They can't deliver on what they thought their earnings growth were going to be. We believe the 4 names that I mentioned are going to still be able to deliver on that, even with these headwinds of inflation and higher interest rates.
Right. Well, of course, the capital is really going to be a hinder in terms of what they can do to grow. And then, of course, they have to service their debt as well. Right. So for these small cap companies, it can be, not even just a utility space, but in general, that have relied on capital to grow and expand in R&D. Now they have to service all of, what they've amassed on the balance sheets. It's really going to be a challenge.
Yes, Jill. Obviously the small cap names, to sum it up, and I think you put it great there, it's just they have fewer levers to pull, right? If you think of, for other industries, though, servicing the capital you spend, you're able to recover all your costs dollar for dollar in utility land. So even if a small cap name is spending $1 billion and the O&M associated with that capital and even the interest rate associated with that capital, that gets recovered through customers. So their earnings should be whole, but we do have this thing where regulatory lag happens where they spend the capital in, say, 2013, but they don't get the revenue associated through a rate case until 2014. So that 12-month or maybe longer lag is going to weigh down on earnings. You have we call that regulatory lag. And even though they're spending it, the small cap names have less levers to pull to offset that regulatory lag. So as you brought up, cost of capital is weighing down with higher interest rates. Not only is it taking them time to recover that O&M from when they spend it to when they start collecting it, now you have higher interest rates that are also impacting the customer bill. So those smaller names maybe have less ability to navigate the inflation and the higher interest rates. And so they're the ones, I think, that those stocks were really cautious on the small cap utilities, with the exception of one, IDACORP, just for we think they're going to really struggle to navigate it. At the onset of the pandemic, as other larger utilities were able to change their business to manage the change in sales. Residential sales really skyrocketed. If you think of the beginning of the pandemic, we all were working from home, but yet industrial companies, commercial companies, they all were actually using less electric. These utilities were great, the larger ones, at navigating that and really cut O&M, trimmed O&M, and were able to still deliver on their earnings growth. The small cap names were not able to do it. They tried, they just have fewer levers to pull. And I think we may see a repeat of that in 2023 as we talk about inflation and higher interest rates.
What does it look like for valuations in the utility sector?
Valuations, they look rich. So if we think of, different ways to value them, we think, and what really drives sector valuation is yield. A lot of people buy this sector for the great yield they provide, great dividend that they provide. And so if we think about it, one of the best correlations we have is a Moody's BBB index. You could pull this up on any of the terminals that you use. Right now, over the last 20 years, we've traded at roughly 75%, roughly 73% to be exact, of the yield. So right now, the average yield of, say, the BBB index is maybe like roughly, say, 6% around there. 75% of that puts you somewhere, let's just say 5%. The average utility yield should be about 5%, when right now it's sub 4. It's probably about 3.5%. So obviously to drive higher yields, you need lower stock prices. Right now, we're only trading at a roughly half of the Moody's BBB index. So right now about 0.52 versus an average of 0.73. So we see the group really expensive on a yield basis, and you need to see stock prices coming down to get back to that average. Now, where we could be wrong is if you think interest rates are actually only going to stay elevated for a short period of time, and we start to see them come down quickly. I don't know if many are calling for that. I think we're debating whether the recession is deeper, shorter, narrower, longer, whatever it is. But on a yield basis, they're pretty expensive. And I think that is also adding caution. We're negative on the entire space. We think the best way to play this quality, as we mentioned those names earlier, because they'll be able to deliver earnings resiliency, and think the smaller cap names may be the most exposed because of the fewer levers to pull to meet the targets.
Right, Anthony, I want to wrap up with what we were talking about in the beginning with the shifting regulatory environment. It seems like it's such a delicate act to balance because, yes, you want to make sure that people can afford their utilities, but in the same token, you don't want to dial back so much on projects, because then you have to start worrying about innovation. And we're always talking about the challenges that we have with infrastructure. Feels like it's just a very delicate act to balance.
Absolutely. The regulatory relationship is probably the number one thing executives in our space need to balance. Some do a great job of it, some struggle. And even when you're trying hard, the political winds of a certain state or their agenda in that state is really going to dictate your success. If we just pick on New York State, my home state, formerly Governor Cuomo, now Governor Hochul, is very interested in a progressive agenda with more renewables and everything else. And the utility Con Edison here has to navigate those challenges. And they also have to do it while maintaining the customer bill. If customer bills go up too high, nobody's complaining about the governor. Nobody's saying, oh, the governor's just really raised rates. They actually, the pushback happens to the utility. And now when the regulators hear that the utility's next rate case to keep spending that capital, make it maybe limited. So that is clearly the hardest thing for these utilities to do. So far, in fairness, the utilities have done a pretty good job of managing that. And the rate cases we've seen come out maybe in the last 6 or 7 months, while some of them had some hiccups in them, in general, they've kept capital plans on intact. We've seen maybe pushback on sales forecasts. The lower the sales forecast the utility has, the higher the rate increase, and vice versa. If I sell more units, the price per unit goes down, so customer bills aren't as higher. That we've seen pushback so far on the margin. We're hoping that's where it stays, and we think the management teams that have this great regulatory relationship will navigate that. But that is clearly where all investors in utility land right now are focused. Does that get greater where now they're saying you're coming with a plan of, let's just say, $5 billion a year of spending, and the regulators are going back to, that's actually aggressive in this inflationary environment. Let's cut that down to $4 billion. That's a 20% reduction. Utilities grow off of, earn off of what they're spending. You start throttling that back, you could see stress to the earnings growth rates that are presented in our sector.
All right, Anthony, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.